Welcome to my channel. I'm the cover call guy, and my goal is to make at least $120,000 per year in passive income using only cover call ETFs to achieve my goal. My monthly progress is about $6,000 per month and annually about $70,000 a year. Legal disclaimer before we start: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I am just some random idiot you found online, and I could be completely wrong. With that out the way, today's video is going to be on my thought process. I was brainstorming a little bit, and you know how I plan to retain wealth using cover call ETFs, right? This is a big deal. I just thought about, is it all about tax advantages, cover call ETFs? Is it all about return of capital? Where should I allocate to which type of cover call ETFs that does, the Nasdaq or the SP 500, or do I do more a little bit of crypto? And so a lot of this I was just brainstorming, and I decided to make a video on this. The meme where the guy's on the whiteboard and he's doing like the whole conspiracy type stuff, so that's what I was doing the past few days, and I was just kind of like messing around with scenarios in my head, writing stuff down, and I just came up with what I might do. So I'll just make a video about it, just share my thoughts and what I think would be the best possible choice for me, and maybe even you, for those who are watching that are early 30s like myself, or even younger, might work for you, or slightly older, might still work for you. So hopefully you guys might have the same process. Let me know, because I love to hear multiple people thinking about the same thoughts, and maybe we can all come to a better plan. More eyes, more ears on it, I think it's always better. And as of today, November 14th, 2025, the market has been a little brutal, right? A little small, tiny dips, 1 to 3%. Not so bad. I love the dips. I love red days. For those that say, are you crazy? This is how wealth is built. You don't buy at the all-time highs. You buy at the all-time lows, or the market dips. The red days, those are that's how you build the wealth. That's exactly how I built my wealth when the market recovered, and it went back my portfolio 2x, 3x, 4x in size, right? This is how you build it. So again, this is just a lot of thoughts and mixed into the video, and I try to reorganize and try to make it as presentable. So bear with me. All right, let's do less talking about this and more slides. All right, so my foundation, right? I'm only going to be using the modern, not legacy tools, right? I'm staying away from Gen 1 legacy cover call ETFs such as QYLD, XYLD, right? They have zero upside, 100% of the portfolio is capped, right? It's very tax efficient, and the mechanical strike strategies suck, right? As of 2023 result, XYLD captured less than 50% of the S&P 500's return, right? I'm sticking to the Gen 3, the tier 1 modern cover call ETFs like GPIX, SPYI. They have a more dynamic upside, so they have a variable coverage from the Goldman Sachs funds, 25 to 75%. All right, the call spreads retain 75 to 95% of the upside, so I get that nice NAV appreciation, right? It's more tax efficient, right? It has 1256, so it has a 60/40 tax treatment, and it has a more active management, right? The institutional teams actively select strikes. So again, that could also be a con, but I see that as a pro. It looks like they know what they're doing, right? For the past 3 years, they have been on a steam, and they've faced a downturn in 2022, 2023. So I feel like they know what they're doing. As a result, 2023 result, modern funds like SPYI captured 96.5% of the S&P's return. Amazing, right? So that's going to be my foundation. Only tier 1 Gen 3 stocks, cover call ETFs. All right, my plan's core trade-off, right? Capping gains to retain capital, 15 to 25%. I'm gonna have to give up them at least 15 to 25% on the bull market gain, which is fine. That's okay. To reduce bear market pain by 30 to 40%, my plan accepts this trade-off. I will sacrifice a small portion of explosive gains in exchange for significant drawdown protections and high income, right? For example, the 2022 bear market proof, S&P 500, the SPY, the drawdown was almost 30% versus GPIX drawdown at almost 20%. So you see it's a 10% difference. And yeah, I think I'm willing to sacrifice that trade-off because I'd rather have the income to live off of. I don't really care about growing the growth stock and then selling later on, as I want to kind of live my life now. So that is the trade-off. All right, evidence why my plans work. I'm using year-to-date 2025 data. Again, I have used and presented 2022, 2023 data. Right, we're comparing it to the benchmarks of QQQQ. Sorry, that was an extra Q. Anyway, GPIQ, SPYI, JEPQ, QYLD, XYLD, right? So we're gonna compare the tier ones to the legacy and the benchmark, right? This is why I use tier one funds. SPYI, GPIQ capture the vast majority of the upside, while legacy funds capture less than half, right? Not a good thing. Absolutely not. All right, my tier one toolkit for wealth retention, and this is why I'm picking tier one stocks only. This is how I'm going to try and retain and preserve wealth and grow it, right? Tier 1's, my Tier 1 Gen 3 cover call ETFs have dynamic coverage, as mentioned before. Goldman Sachs has a 25 to 75 variable coverage, retains 75 to 85% upside, and has good tax advantages. They use a call spread, which just buy and sells calls to create a profit zone, not a hard cap, right? I don't want a hard cap. If it caps hard, then I at least want the strike price to be high, out of the money. Right, and they had selective evidence as shown. Their history has been great, such as Devo and QDevo, right, from Amplified ETF. Absolutely love them so far. I've actually, disclosure, I actually been holding Devo for a while before I switched over. I sold out and just rotated the my full rotation to QDevo. So I'm still sticking with Amplify. I've been loving Devo, but I just wanted double the yield and with a little bit more aggressive growth and income, which is just QDevo. QDevo is just Devo on steroids. So I said, you know what, I'll take that risk. I love how they've been performing so far. The managers chooses which stock to cap and when, so they've been doing a great job so far, and I have no problems with them. They've been showing me why they're tier 1. All right, my toolkit, what I might be excluding and why, right? A note on JEPI and JEPQ. They are popular, high-quality funds from JP Morgan. They are elite defensive tools proven in the 2022 bear market. Absolutely good foundation. They're like a rock. Mechanism, they have 80% defensive stock portfolio plus 20% equity-linked notes, ELNs. Their strengths is a massive assets under management, right? Everybody, when you mention JP Morgan, everybody who knows who that is. When you mention Morgan Stanley, you know who that is, right? If you're, especially, you don't even have to be in the financial world to know. You could be a regular 80-year-old grandma, and they're like, oh yeah, I know that's a bank with finance, right? They know, right? According to Morningstar bronze rating, right, they have superior drawdown protection. But however, my key consideration, right, for my taxable plan, I need to keep as much money as I can. When I no longer work or can work, the income from ELN sleeve is taxed as ordinary income up to 37% max rate, right? It's taxed like I'm a W-2. No, that's not good. That's the highest tax margin, right? That's the highest tax group. I don't want that. I need to keep as much money as possible, right? Especially if I can't work anymore for whatever reason, right? Medical, health, family, something, whatever. No job, AI took over, right? This makes them less efficient for a taxable account as it creates a significant tax drag on the yield. My plan, I'm going to be prioritizing Section 1256 funds in my taxable plan. I will consider JEPI, JEPQ if I have a tax shelter account in the future. Right now, I don't think I will ever open one, so I'll have to put JEPI, JEPQ on the sideline. I will probably consider them as a secondary tier 2 maybe. They might be like just above my satellite cover call ETFs, my turbo high yield booster ETF cover call ETFs, right? So they'll be above them for sure. But I will definitely right now I'm gonna be prioritizing the tax advantage no hard cap tier 1 cover call ETFs. All right, this is my blueprint. This is what I'm going to be forming. These are the stocks I will probably definitely own. I will probably be adding at least 2-3 more tier 1s. I'm missing the real estate from Neos on top of my head, and I'm probably missing like 2 more. So this is probably going to be this is just my core right now. I'm obviously going to be adding, like I said, adding a few more. I'm going to obviously those percentages are just going to change. This is just an estimate, a little diagram to show my my thought process visualized. Yes, I haven't include my satellite into this because again, they are my satellite. Um, they will probably most likely still be in there, but again, I just want to include my tier 1s because those are gonna be my pretty much my forever buy, hold, set and forget type of cover call ETFs. My satellite, of course, they're gonna be ever changing and they're gonna always be on the sideline, right? I'm like, yes, they're gonna be there, but if something happens, they're the first to go. All right, this is my plan's expected outcome, right? This is based on my 100% model, right? 70-80% estimated bull market upside capture. My plan is to design to retain the majority of market gains, right? I want to be able to follow the market, follow the money. 8.5 to 10.5% of it is blended annual yield. My plan provides a significant, consistent income stream, right? I don't want to be into the crazy yields, right? When I live off this income, I need it to be stable. I need it to be reliable. I need it to be consistent, a consistent payment. If I start going above 15, 20, 25%, I really can't enjoy my life, right? I would have to be on the market, watching my phone every single day. I would be that active trader. I want to be more of a passive trader. I want to be able to sip my drink on a beach, enjoy, and just red days, who cares? It's fine. I just go back to sleep. Green days, it's fine. I just go back to sleep, right? I want to have that nice, easygoing lifestyle. And then 75% of my portfolio is going to be tax advantage to the max. My plan is to benefit from efficient 1256 or qualified dividend treatment. All right, my plan's 30-year wealth impact, right? I want to think how this will handle in 30 years because I want to live off my income for a minimum of 30 years. Obviously more, but let's just say standard 30 years, right? The growth 100% S&P, it's always going to win in growth. It just is, you're not going to beat them, right? There's no argument. I'm not trying to make an argument. For those in the comments, oh, why don't you're young, why don't you do growth? Again, I want to live off my income now. I don't want to be waiting until I'm 50, 60 and then live my life. All right, my tier 1 cover call plan in 30 years will just slightly be below the the pure growth 30-year buying stacking. And then the legacy cover calls, right? The QYLD styles, right? They're just absolutely completely left behind, right? In a not even barely over 500,000 compared to my tier 1 cover call estimated plan will be at least 1.1 million, and then the pure growth would be about 1.4 million. So this is the trade-off, right? And this is the after tax, my estimated. You guys can use this. Guys can go on Google and use the calculator and do an estimate yourself. But this is what I came out to using my portfolio. Everyone's portfolio is going to be different depending on your allocations, right? So again, this is just a visualization. I know I'm not going to beat the growth, but I know I will definitely do better than just juicing up on the high yields. All right, my plans, how my plan retains wealth, right? Tax optimization, like I said, I'm going to be saving at least $1.1 thousand in actual tax savings on a $100,000 portfolio. I will probably start living off my portfolio once I hit at least 1 million. So just do the math, 10x. How? Like I said, section 1256 versus ordinary income. My tier 1 plan, GPIX, SPYI, and many more. 75% of my portfolio distribution gets favorable 640 or qualified dividend treatment. Right, the average tax rate is 20%. Tax owed is about 9.2K, 1,800. And then the legacy JP portfolio distribution or tax as ordinary income, tax rate at 32%, tax owed 9.2K on 2,900, right? So you see that huge difference here. You see that huge difference, taking away 10 grand of from 10 grand, you're paying that about $1,000 difference. So imagine if your portfolio was $1 million, right? So that's just pretty much 10x everything, or in this case, 100x. Huge difference, a lot of money loss. My plan's protection, right? I need to know, I want to know how my portfolio will do. I need to protect my portfolio at all costs, right? So NAV health check, right? I want to make sure that there's no NAV erosion, right? The NAV can fall, just not consistently, right? The NAV falls and then it recovers, right? And then during a downturn again, it falls and then it recovers, right? So if it starts falling consecutively, especially for 2 consecutive quarters, right? This is a sign that the NAV is eating itself to pay me. Then I have to cut that out, right? Not a good cover call ETF. Performance benching, right? Each fund has a job. It is, if a fund fails its minimum upside capture threshold, right? SPYI less than 80% for 12 months, I will replace it, right? Then that means the fund manager, the strategy, something is going on. Perhaps they no longer have the same team and they are no longer executing to its fullest potential, or they change the strategy, or they just don't know what they're doing anymore and they're just trying to take the money and run and then close the fund, right? So that is something you have to think about. Of course, that gives you time. You look at it at a 1-year scale. And then my exit triggers, right? I will exit any positions that show a 3-year negative total return. This indicates a structurally broken fund, not just a bad market, right? So if the cover call ETFs has a 3-year negative total return, first off, I'm not gonna even touch it. I'm not gonna even buy it. I'm staying far, far away from it. However, if it was doing very, very well, it never showed a 3-year negative total return, I buy into it, and then a year, 2 years later, it starts showing these signs, and then for 3 consecutive years, it just going downhill. Then that's not a bear market. Bear markets, unless a bear market was really lasting that long, then I might reconsider. But if a bear market was a year and then we had 2 years of bull market and it was still doing bad, yeah, it's got to go. It's gone. I'm out. All right, my plan's adoption, right? The VIX tactical overlay. This is how we kind of based our option premiums and how we have a baseline, right? So the VIX is basically how fearful and how not fearful the market is, right? So the VIX is under 15, low volatility, premiums are low, right? I will reduce allocation and shift 10% from core GPIX to growth focus QDevo, SPYI. I won't like shift as in sell it. I would shift as in when it pays me, I would grow the QDevo in SPYI, right? And from the income. I don't sell, but that's when I say shift. So let's not get that confused. When I say shift, I'm just gonna make my other positions larger, if that makes sense. Right? I'm not selling anything, right? I don't want to cut a solid cover call ETF just because the VIX is low. VIX is just an indicator for you to be like, oh, okay, so the market's trending this way. Let me just increase my other positions. Right? When the VIX is 15 of 25, that's normal, right? That's kind of like a baseline. That's like a little somewhat choppy market, up and then down, up and then down, up and then down, right? It doesn't do much, right? The economy is doing okay. It's not too hot. It's not too bad. The labor market is doing fine. Inflation is tamed. That's like kind of the VIX normal, right? For the most part, people have jobs and there's nothing crazy going on in the world, right? No one's trying to nuke each other, right? So that's normal, right? So I will just maintain my target portfolio allocation and reinvest all my distributions after, I live my life on a nice yacht and whatever's left over. All right, when the VIX is over 25, that's elevated. All right, premiums are high. I will deploy cash reserves. All right, this is my optimal time to sell volatility and build my position. That's when people are like freaking out and something's going on in the world. Something's going on with the United States. Something is making people scared, right? Like this market right now, high inflation. There's no jobs. There's possibly World War III that might pop off, right? A lot of things are going on. The Trump administration is not releasing any data. The Fed doesn't know what they're doing or doesn't know what to do, right? So They said they would cut rates in December. Now they're saying they might not cut rates, but there's a possibility, so nobody knows what's going on. All right, my plan's honest trade-off. I have to be honest with my gains versus my sacrifices. What my plan gains is 8 to 10% annual income, 30 to 40% smaller drawdowns, psychological comfort, right, of monthly cash flow and lower volatility, at least 75 to 80% upside capture, right? And my break even is my plan wins if I would otherwise panic sell. Right? I don't take a loss. I just break even. But however, what my plan sacrifices about $325,000 and opportunity cost over 30 years versus a peer index. That would just be paper. That would be paper money. Right? Not actually losing the money. That would be just the paper money, because eventually. Well, okay, not paper money. All right, I'm wrong in that. Let me do my correction. Yes, you would miss about $300,000 because you would sell the growth, and that would how much you'd be up by. However, you would have to wait until 30 years for you to actually have that money. So in terms of losing that money, it just depends on how aggressive you reinvested. This was just based on my portfolio. Your portfolio could be different. Your portfolio could be much less, or even matching, or even greater. So this is what my plan sacrifices. I'm okay with that. Right? It also sacrifices 100% participation in explosive bull years, right? I'm okay with that. Again, I'm focused on the income, the quality of the income, the quality of the NAV. Right? I missed out on compounding on 20% upside that I do sell, right? And I missed up on simplicity, right? My plan requires active monitoring. It's not as aggressive, but it does require me to stay tuned on what I mean by active monitoring is I do have to stay tuned to the news, to the current events, right? I have to check up on what the funds are doing time to time. I have to see how they're performing time to time. If the payouts remain the same, right? Every month I have to track it, every week, or if I have a weekly, I have to track it. So that's what I mean by active monitoring. Not like actually actively every 30, 40 an hour on the phone. That's not what I mean. But what I mean is like the index funds, you don't have to do anything, versus I do have to check up on what's going on in the world, what's going on in the United States, what's going on with the company. What I might consider in the future, right? The 80-20 hybrid model, because of the gains and sacrifices. I did make a backup with a possible hybrid model, what I would consider, right? The alternative blueprint is the 80-20 hybrid model, which is the 80% uncapped growth, the primary wealth engine, or the 20% premium cover cost slaves, right? GPIQ, is it GPIQ? No, not JetQ, GPIQ from Goldman and Devil, right? A behavioral anchor for income, right? So if once I reach my certain goal and I have enough in a portfolio, I might rotate a little bit. Right? This is the 80-20% model. I just put it there because I could do 50-50, but this model captures 90% of the market upside and result in a $342,000 more wealth over 30 years. That's why I put 80-20. But I could do 50-50, or I can flip it and do a 80% income, 20% growth. This is just what my alternative blueprint for it. If I want to do more growth and more make my portfolio more passive than it is. I might not even do it. I might not even care. But this is just something I think about, something I would consider if in the future things change. All right, and then my implementation roadmap. All right, month 1 of 6, education and initial position. All right, you might want a paper trade right here, track the NAV, the VIX, and then open 25% of GPIX, GPIQ. This is how I would start out. Right, for those starting out, would be like my game plan. And then month 7 to 12, build 60%, add some satellite positions like Devil and SPYI, reinvest all the distribution, right? And then year 2 to 3 is optimization, right? Complete to build 100% target, implement VIX tactical overlays, and then Devil and SPYI might not be satellite. They might end up being a core, right? So you want to start pushing your satellites into your core as you start building out your positions. And then year 10, will be your major review, right? Assets actual versus projected incomes, and consider 80-20 hybrid if you are lagging and you might want to change, or we don't know how tax law is going to change in the future, right? Then we might have to switch over. It's just something to think about. This is just like a what I think about in my head, and I just kind of put it out there. So this model is just, again, an illustrative model, just something for you to visualize what you could be doing. And then my cover call game plan, my game plan conclusion, right? My plan is viable, more modern tier 1 funds or superior wealth building tools, not a value trap. My plan is defined, right? The 100% tier 1 portfolio is designed to capture 75 to 80% of the market while providing high income. My plan is an active choice. I am knowingly trading 15 to 20% of total upside. Again, that is just a trade-off. You had something you have to let go for the people that want to get into income. That is just something you have to let go. You have to be okay with it. My human capital it just means as I'm in my 30s, my career earnings are my most valuable asset. This plan provides stability to let me focus on that, so I don't have to worry about constantly getting laid off, right? I'm like, all right, if I get laid off, this is my plan. So I just focus on my work, earn as much as possible, get my promotions, and then dip. Like, comment, subscribe, right? Let me know your thoughts on this game plan below. I know if you guys agree, if you guys disagree, let me know. If you think it's a good plan, bad plan, crappy plan, you know. Thanks for watching, right? Stay tuned on next, and I hope you guys enjoyed it.